Hey everyone, this is Elijah Johnson with FinanceAndLiberty.com, and back with us today is Alasdair MacLeod from FinanceAndEconomics.org and also GoldMoney.com. Alasdair, thank you so much for your time today.
Not at all. It's my pleasure, Elijah.
All right. Well, I'd first like to discuss a little bit about the Greek debt crisis. We're hearing a lot about it in the news. You recently stated that the Greek debt crisis is actually, in a way, weakening the credibility of the euro currency. Did you want to discuss a little bit about this?
Yes. Basically, the euro is a very young currency, and it doesn't have the track record, if you like, of money that, say, the dollar has, or sterling, or indeed, I suppose, the yen. And consequently, it is a lot more vulnerable to being questioned by the people that use it than perhaps the ECB really realizes. There is a theory, if you like, that was really an Austrian economics theory, and that is that the use of money always goes back. It should go back eventually to a point where it had value as something which wasn't money. And that certainly applies in the case of gold. And silver, for that matter. And if you look at the dollar, that has value in our minds because originally it was something that you exchanged for gold. So it was as good as gold way, way back in the past. So we have the habit of using a currency like the dollar, which is far more established than we have in the case of the euro. So if the euro is vulnerable to knocks in its credibility, then what's going on at the moment with Greece actually has a very serious implication. And that was the point I was trying to make.
Now, you've also written about how people's deposits in banks in Greece are possibly going to be subject to bail-ins. Did you want to discuss about how the same kind of bail-ins that we saw in Cyprus could happen in Greece? Yes.
As long as Greece remains in the Eurozone, then it is likely that the resolution of insolvent banks in Greece is going to be out of Greece's control. It will be, in effect, dictated to them by the ECB and other members of the Eurozone. And since the Cyprus crisis, which was a couple of years back, what's happened is that all the major countries have passed legislation enabling banks to be bailed in rather than bailed out. Now, I think it's fine to bail in. I mean, well, fine in the sense that it's not likely to create a crisis if you bail in one bank, which is not systemically important. If, on the other hand, you try and bail in a complete banking system, then I think it's likely to end in tears. It's not a good situation, and the longer this persists, the greater the pressure on the Greek banks because depositors are taking money out of them. And they're not only taking money, but they're spending their balances. I mean, I've seen reports that Greek citizens have been buying motor cars, Mercedes cars, if you like, as a means of turning their deposits into a mobile asset. Because there's no doubt about it, if the bank goes bust and you've got a deposit in the bank and you are bailed in, then you don't have any money in the bank. It's actually as simple as that. Having said that, there is a guarantee, if you like. I think it's 125,000 euros per bank deposit. So that, I think, is encouraging people not to panic. But it's that sort of reliance on governments actually coming up with the money is something that I think and increasingly people are likely to be wary of.
Now, I know we've seen these bail-ins happen in Cyprus, and now if it's going to happen in Greece, what is your perspective on how could that become a normal thing that we'd see around Europe and then possibly moving towards the United States, these bail-ins?
Well, the central banks want bail-ins to be the normal way in which these problems are resolved. And as I said just now, I think that in the case of a single bank getting into difficulties, obviously it's a sensible way forward. If we ignore the existing rights, if you like, of creditors and impose something on top. But when you get more than one bank going, then I really don't think you can do a bail-in. But the preferred route, obviously, is to go for bail-in, and I just hope that in the event of a crisis, that the ECB and the powers that be, if you like, the monetary powers that be in the Eurozone, actually sort of think twice before going for bail-ins, as opposed to accepting that quietly bailing something out is probably a better route.
Now, before we move on, I'd like to discuss a little bit more about Greece. In a recent article you wrote, you talked about how a lot of macroeconomists right now think that currency devaluation is a good way to solve the problem of trade deficits. But in your opinion, this is actually not a good solution. Did you want to discuss this and how it relates to the Greek debt crisis right now?
Well, the evidence of history shows that trying to manage a trade deficit by devaluing the currency really doesn't work. I mean, if you go back to post-war, in the post-war years, Japan and Germany had very strong export performances, and at the same time their currencies were rising. The fact that the currency rose, both the yen and the mark rose, and it didn't dampen down the trade surplus, I would have thought is a pretty good indication to the Keynesians in particular in countries like the UK, which were trying to do exactly the reverse. I mean, in the UK, we were trying to devalue so that we would be, competitive when it comes to our products in the marketplace and all that sort of stuff. But the result of this was a constantly declining currency, and it did absolutely nothing to reduce the trade deficit. So you can see that the whole thing works on a different basis. And I think the way to understand it is to think in terms of Say's law, which is the law of the markets. The only reason that I can go and buy something is because I have earned the money in order to do so. So in the private sector, all of us who are in that position do precisely that. We work for something, we get paid, which is, if you like, stored labour, which we then go and spend on the things we want. Now, it doesn't matter whether the thing we want is, made in Germany, made in France, made in the UK, made in the United States, made in China. It really doesn't matter, because we have produced something in order to purchase something from abroad. So there is a balance, if you like. It works out that there is a balance in terms of productive effort in the countries. So you will tend to get no trade deficit, no trade surplus under those circumstances where the private sector only is involved. There are two ways in which this balance is disrupted. The first is if bank credit expands, is under those circumstances what happens is that you are taking credit which has been created out of thin air and injecting that into the market for goods. And so that will obviously create extra demand. Now, that demand could well end up by developing a trade deficit because it enables you to go and buy things which you otherwise wouldn't buy, either in your domestic market or indeed abroad. So that can generate a trade deficit. But if the expansion of bank credit is a cyclical expansion, which is generally the case when a central bank fools around with interest rates, then when you get the crisis, when you get the contraction of bank credit as part of the cycle, obviously that trade deficit would disappear. But what then happens, of course, is that the central bank comes in and it injects money into the economy to try and compensate for contracting bank credit. And this is what the Fed has been doing with QE, for example. Now, under those circumstances, then you're not going to get the reversal of the trade deficit into a trade surplus, which would happen if that extra money hadn't been injected into the economy. So, the intervention by a central bank is one way in which a trade deficit can be created. The other way is simply with government spending. If the government tries to create a deficit in order to create extra demand to try and rescue the economy, what happens is that there is insufficient capacity to manufacture what people want. And usually this is money which is either spent directly by the government or given in the form of welfare or whatever it is to individuals. that extra demand cannot be satisfied domestically. So inevitably, what happens is that it sucks in imports from abroad. And this leads to something which is known as the twin deficit hypothesis. You will find that, and this history bears it out, a lot of the time when you get a budget deficit, you get a trade deficit. The two things seem to be linked. And so those are the relationships, and that obviously, if you like, goes against the whole concept that you can manipulate demand for overseas goods. You can, diminish it by raising the prices, by lowering the currency, and by lowering the currency, you might make goods marginally more attractive to foreigners. So that's meant to boost your exports. Doesn't work like that. What happens is that the markets actually work on the basis that if you spend something, then you have earned it. You have produced something in order to do it. Now, the monkeying around with the system is always governments breaking that cardinal rule of Say's law. I hope that sort of puts it in a bit of perspective. What's really happened as far as Greece is concerned, I read in papers almost daily, newspapers and also economists writing about the subject of Greece, that really what Greece wants is it should leave the euro and it should reintroduce the drachma. If it could manage its currency, then it can reduce its labour costs, domestic labour costs, so that they are internationally competitive and the economy gets rebalanced. In other words, screw the natives, if you pardon the expression, screw the natives, and everything will be all right. I'm sorry, it doesn't work.
So do you see that's what they're actually going to end up doing? And if so, I guess, did you want to elaborate on how this will affect the Greek economy?
Well, I think the first thing is that we would have to see whether Greece actually does leave the Eurozone. I don't think that's a done deal. I mean, the one thing I am absolutely certain of is that leaving the Eurozone isn't going to cure anything as far as Greece is concerned. If she introduced her own currency, I really don't think it would have any credibility in the foreign exchanges, and it would fall very, very rapidly. I don't think it would even have credibility amongst the Greeks. So I really just don't. I cannot see that as being, if you like, a credible path. Now, if I'm right, and they remain in the Eurozone, then you've got a currency which everybody will use. But what it means is that the Greek government will not be able to finance its spending by printing money. It will have to rely on the existing pool of euros, which happen to wander into Greek borders, which is absolutely fine, and that's the way it should be. Now, under those circumstances, I think Greece, which I would incidentally think would default on its debts as part of this, I think Greece, as a country or as a nation, could well begin to recover quite quickly. Now, that brings forward another thought, which is really rather worrying as far as the Eurozone is concerned, and that is that it's not just Greece, but you've got problems, if you like, with the Italian economy in particular, which is very, very heavily indebted. Spain is also indebted, but to a lesser extent, but has a similar profile in terms of unemployment to Greece. And you've also got France, which is rapidly disappearing down the plug hole of deflation. And I think that if Greece actually does leave the Eurozone, you will find that there will be increasing political pressure, particularly in Italy and Spain, for those countries to do so as well. So Greece leaving the Eurozone actually does have very, very important and potentially negative implications for the rest of the Eurozone. And the other members of the Eurozone actually do understand this point. And so they are very, very worried about Greece leaving the Eurozone, and they would rather have them in than out. But I think if Greece remains in, then the debts have to be dealt with, and the debts basically should be defaulted on. So it'll be interesting to see whether that bit is permitted.
Definitely, and I'd like to move our focus now to the United States. You recently wrote another article about the bond market, and you said that you are expecting a bear market in the U.S. bond market and that this bear market will be a trigger for another financial crisis. Did you want to discuss about this?
Yes, certainly. The point about bond prices is that banks have loaded up with government bonds. The Basel banking regulations encourage this because they treat them as having zero risk. There is no haircut, if you like, in holding those bonds, compared with, say, corporate bonds. I mean, with corporate bonds, you have to take a haircut. You have to reduce the value of those bonds as collateral against your balance sheet for the purposes of working out capital ratios. So government bonds have been very, very attractive to the banks. They have been in competition to an extent with their central banks who, as part of QE, have been buying up bonds. And the combination of zero interest rates plus QE has created a shortage which has led to exceptionally low yields in all government bond markets. And no more than six weeks to a couple of months ago, of course, we were looking at a situation where as many as 1/3 of government bonds around the world were either yielding zero or were, horror of horrors, on negative yields. So now that really is as far as you can possibly go when it comes to raising bond prices. Since then, of course, the yield in US Treasuries has been rising, which means the bond prices have been falling. Now, the US banks, I think, have paid pretty close attention to improving their balance sheets since the Lehman crisis. So they can take a rise, if you like, in bond yields, or looking at it the other way, a fall in bond prices to some degree. What that is, obviously, we don't know. We will know, if you like, when bond yields rise to the point where a crisis ensues. My guess is you're probably looking at, if the 10-year US Treasury yields over 3%, I think we could well be getting into crisis, into a crisis zone. The problem is a lot more acute in Europe, because there the banks are very, very heavily exposed to their government bonds, their own government's bonds, and I think in some cases a yield rise of as little as 1 or 1.5% from current levels could well threaten the stability of major banks in the Eurozone. So I would see rising bond yields, which I think is naturally beginning to occur because we have seen a peak, if you like. That, I think, is probably the greatest systemic threat we have at the moment, outside the Greek situation getting out of control.
Now, I know on these interviews we usually like to talk about the precious metal markets, so I'd like to know your opinion on how what is happening in the bond market could impact the precious metal markets. Do you see precious metals being affected at all?
Well, at some stage, I think that's bound to happen. People will get interested, I think, in precious metals when either of two things happen. The easy way to describe it is that if they perceive that they're now in an uptrend, then people will bite because they are very underexposed to precious metals. So that's one driver that could turn them round, if you like. It's a momentum thing. The other thing is that if you do get a crisis developing, we now have a situation where in Greece or around Europe, if people start worrying about the security of their deposits in their banks, and given that the central banks have effectively limited you from withdrawing cash out of your bank as opposed to moving a deposit from one bank to another, then really the only way out of the banking system is to own precious metals. And so far, the only people who have taken this route have been Asians. The Europeans and Americans seem to be holding back on it, basically because gold and silver are, I think, out of fashion. And at the same time, nobody really understands what systemic risk is. We had systemic risk back in the Lehman crisis. That was what 2008. It was a long time ago for current investors. Their time horizon is a lot less than that. So as far as they're concerned, they are not thinking about systemic risk. But the moment they do start thinking about systemic risk, then there is going to be big demand, I think, for physical metal. So those are the things to look out for. What I'm personally interested in is, I don't know if you're aware, but Gold Money has been acquired by a company called BitGold, which is listed on the Toronto Stock Exchange. And BitGold has a debit card which is backed by gold. So if you put dollars or euros or pounds or yens or whatever your currency is into your BitGold debit card account, it is immediately converted into gold, physical gold, and when you spend your money, the gold is sold to cover the currency which you're spending your money in. So as a debit card, if I go go to France, I can use it for euro transactions. I can use it for sterling transactions. If I go to America, I can use it for dollar transactions. So this is this, if you like, is a very interesting development. It allows you to get out of the banking system in your day-to-day transactions. Now, obviously, you're taking on a risk, if you like, of the gold price, but that is probably an acceptable risk given that the gold price has fallen to levels where, by any measure, gold is very, very good value.
Now, besides BitGold, do you see it's important for people to have physical gold and silver on hand?
Yes, I do, Elijah. The argument is very, very simple. If you have paper gold in the form of futures or ETFs, then you are in the financial system. You are not in gold. And I think that the difference is very, very important to grasp. The point about having gold and being able to spend gold for your transactions is that you are insulated from the problems and the risks in the banking system. And that is the whole raison d'etre for doing it.
Definitely. Well, Alasdair MacLeod, thank you so much for joining us today. I guess before we let you go, did you want to share with the viewers where they can find you and any last thoughts you might have?
Yes, financeandeconomics.org and goldmoney.com. Those are the principal ones where you'll find my work. As in terms of other thoughts, I think one thing I would like to say is that I've been watching the build-up of the short position in silver on COMEX, and that is now very, very substantial. And you will have noticed, or some of your readers, some of your listeners might have noticed, that the open interest on COMEX is at all-time records. It's now over 1 billion ounces equivalent, which is more than 1 year's production of silver. So there's something going to break quite big, I think, in that market, and it may well involve someone getting into difficulties in the process. So that's going to be an interesting one, and my tip would be watch that space very carefully.
This video was brought to you by ReluctantPreppers.com. Click here to watch Reluctant Prepper's latest interview with Rob Kirby. Rob Kirby, former bullion banker, expert on financial markets, and founder of KirbyAnalytics.com, returns to ReluctantPreppers.com to connect the dots from the Eurozone to the globalists who formed the Federal Reserve and exposes whether the elite have the U.S. in their sights for a new world order. In Part 2, Kirby brings the global threat down to how it impacts the individual family, and outlines his top 3 priorities of recommended steps that prudent individuals must take now.